Bloomberg Audio Studios.
Podcasts, radio, news.
Single best idea. We usually do two voices. We're going to do three today. It was such a rich program of conversation. Marilyn Watson from BlackRock in London, I thought, was really quite something about linking in the geopolitics and the multiple political stories into higher yield. We are seeing a higher yield here. She suggested it was an opportunity. One person's opinion, many other opinions as well. Major shout out to Randy Boyd of the University of Tennessee. Really learned a lot about the land-grant school experience right now. He did point out that Tennessee baseball did better than good in the College World Series, but it's always good to speak to a college president about the huge challenges faced worldwide in the education of the youth, of America. Let us begin. Jim Caron was just wonderful today from Morgan Stanley. He has prodigious physics and mathematics skills, and not only looking at fixed income, but looking cross-asset. And that means there's that classic model, 60-40.
It's not that the 60-40 doesn't work. It's just I think that the 60-40 will be suboptimal. And the reason why the 60-40 portfolio will be suboptimal is we have to take a little bit of a trip through history. If you go back to 1981 to 2021, if you look at that 40-year period of time, bonds did very well during that period. 37 out of 40 years they made money. So very stable, very good returns. Your Sharpe ratio or your risk-adjusted return, if you had a 60-40 portfolio, was roughly 7%, which is great. Passive investing 60-40 did really well for that 40-year period of time. If you look from 2022, 23, and into 24, what you're seeing is that bonds are becoming less stable, less reliably, producing good, solid returns, and that's likely to occur into the future. So what it would suggest is that now the 60-40 might not give you passive, might not give you 7%, but it might actually only give you 5%. And that's a meaningful difference in types of returns. So I would say that the new way of thinking about how do we use bonds to hedge our portfolio needs to be a lot more flexible. So it could be 70-30, it could be 30-70 in some instances. Really what we're trying to account for is the volatility of returns in bonds, which we think will start to follow the business cycle more than just being a 40-year downward trend in rates and strong performance for that period of time.
Struggling with the end of the great deflation, the great moderation, I should say, rather. Interesting to see Jim Caron there on 60% in stocks, 40% in bonds. Maybe in Europe it's the other way around, 60% in bonds, 40% in stocks. But a lot of mystery to what this broad institutional formula will do. There's no mystery that the linkage of Ed Hyman economics with Julian Emanuel equity market strategy is always valuable. At Evercore ISI, Mr. Hyman, of course, some would argue inventing market economics, always has looked, every moment Ed Hyman has looked to the belief in the American system. We pause today with Julian Emanuel of Evercore ISI.
My 93-year-old father-in-law recently departed, lived a great life, basically was in stocks until the end, as much as in stocks as he could possibly, because he believed that when you look at it, and the data supports this, through economic cycles, through political turmoil, through geopolitics, wars, all of these things, that stocks are the long-term income producing asset. And frankly, when you think about the things that we're trying to hedge, inflation, again, some of these uncertainties. The other fact is that if you look at it, the price chart of the S&P 500 mirrors the growth in earnings. And if you're going to get long-term earnings growth, which we do believe in fundamentally, you must be in stocks. Julian
Emanuel there on a father-in-law of a vintage 93 years. Eric, could you see me, here at like 89 or 90? Single best idea today. They got the retirement party scheduled for the end of this summer. I'm kidding, folks. We did a bonus round today. We had to with Bob Dahl. Bob Dahl is legendary in the business. He's always in the market. The glass is always half full, even if he counsels a buildup, a use of cash to find a better day to buy. Really rich conversation again today with Robert Dahl of Crossmark.
COVID just threw so many typical patterns off their normal course, and that's confused so many of us. For example, all the excess savings saved us from an economic slowdown, if not a recession, last year. That's just one example. So the models that people use are causing them to scratch their head because they're just not working. And I think there's more of that to come. I think there's a false sense of security out there that everything's just fine. I mean, look, when the market's selling over 20 times earnings, things better be close to perfect, right? And they're not. The economy is slowing. Inflation, while probably going to come down some more, is stubborn, sticky. It's not going to get to the 2% Fed target. And you've got these double-digit earnings expectations for this year and next year. I can't square all those very positive circles and come up with a reason why at 5,500 I got to jump in with both feet. So I'm a little on the cautious side, fully invested, but really careful about what I own.
Robert Dahl, there with the history of COVID and coming out of COVID. I do want to say I saw one indicator at the end of the pandemic today. It was heartening. Catherine Doherty writing this up for Bloomberg. In the CFA program, I'm a member of this CFA Institute. You take 3 exams, level 1, level 2, level 3. Level 1 is like really, really basic, really, really hard, really a lot of people flunk. And you can take it again, and it's great. It's a rite of passage. CFA level 2 is considered, I think, by many to be the really toughest exam. And what a rebound today in the announcement of 59% of people passing the level 2 CFA. And to me, with all the gyrations everybody's had with COVID, it's a really constructive sign that we move beyond all that we lived with in the pandemic. We're out on YouTube, Bloomberg Podcasts. Search Bloomberg Podcasts and subscribe. We would like that. Apple CarPlay, with Apple coming out with a new version at some point, and Android Auto as well on Apple Podcasts. This is single best idea.